closed-end funds are more than yield and discounts. They're manager performance and their asset allocation. So you don't just pick a fund because it has a high yield, but it needs to fit in your portfolio, and you need to have a reason that you're there.
If you're one of many investors looking for yield, closed-end funds may interest you. John Colescott of CEF Advisors even calls them, as he put it, yieldy. That's yield with a Y. But he also notes that closed-end fund distributions are not like bond coupons. Payout levels may change, especially in a rising interest rate environment.
So a lot of closed-end fund investors don't seem to realize that closed-end funds aren't coupons or bonds. We always say that closed-end funds are listed equities that either derive their value from equities or bond guts, and that the distribution policies are policies, not promises, and can't be thought of like coupons on bonds. 97% of closed-end funds changed their distribution policy the last time rates went up. 65% or so did it from our data in the last year, and almost half, 45%, did it in the last 6 months. So you can't think of a distribution policy as stable. They go up and they go down, and you have to study them from our research. So when I say closed-end funds are yieldy, what I mean is 92% of them pay quarterly or monthly. That the average closed-end fund on the bond side for taxables is paying close to 8% historically in the current environment, and the tax-frees are currently doing about 5 and change based on the current indicated yield. Look at the equity funds, are averaging close to 8 based on the distribution policies set by the boards. What happens in the sector is that a lot of the equity funds are passing through realized long-term gains and short-term gains as part of their policy in an attempt to narrow discounts. The bond funds benefit from fixed capital and discounts and leverage to make the yields higher than other structures, in my opinion. Sometimes they don't realize, and this sounds a little ridiculous, that there's a net asset value as well as a market price. So you got to pay attention to whether the price is above net asset value, below, and where that trend historically is above or below, and where the neighborhood or peers are, because that helps insulate you from potential down gravity of discounts widening. Other factors we see, liquidity, people avoid some less liquid funds, and they'll pay, in some cases, 5, 10, 15% more for a similar fund just because it trades twice the share volume, and that doesn't sound like a good idea in our opinion.
For more information and data on closed-end funds, visit our sponsor, CEFConnect.com, the authority on closed-end funds. This is Closed-End Fund News.